Hello everyone, welcome to Demand Supply Trading Practical Session number 3 for the year 2025. Myself Surjit Kakkar, and today is Sunday 19th of Jan 2025. Now before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, before we move ahead, I would like to add that we have a Telegram channel where we keep updating you regarding when these sessions are getting scheduled. If you have any updates regarding, let's say our products, our offerings, if we have any uh, uh, offers coming up, that is where we keep updating you. So in case you want to join the channel, you can scan the QR code which is available on your screen. Otherwise, you'll also be able to find the direct link in the description. You can also go to our website. Just give me a second. Right, so you can also go to our website, and as you scroll down near the footer, you will see that you have the option to join the Telegram channel. You can click on join now. That is also where you have the option to join the Telegram channel from. All right, so let's move forward. So yes, like I said, you have to go to our website. Uh, if you want to click on that button and if you want to join, there are also a lot of other stuff which is available on our website. We'll be talking about it as we move forward, but the question here is, what is the URL for the website? So it's surjitkakkar.com, or if you need the short URL, then you can go to sk.coach, which will redirect you to surjitkakkar.com, right? So those are the two URLs which you can use to access our website. All right, so today's session is a practical application of demand supply methodology. So our demand supply course is now available as a 100% free course. You can learn the complete methodology from the beginning to the end theoretically by accessing the course. Now, once you're done with the course, like I said, it will be the theory part, but unless and until you see some practical application, at times we don't get a very good understanding of how to use the methodology to plan trades. And that is what we do once a week. So once a week, I do a session where we take some practical examples. And to those practical examples, we apply the complete methodology so that you can understand how to plan trades very mechanically, very rule-based using demand supply. Now, there are some prerequisites. And what are these prerequisites? The first one is the Trading Essentials course. Now, if you already have a good background in trading, this is something optional you can skip. But if you're starting as a fresher, then I'll definitely recommend you to start with our Trading Essentials course, which is also an absolutely free course. Now, talking about accessing these course, how can you do that? You have to come to our website. You don't have to create a account. You don't have to provide any credit card details. Like I said, the courses are absolutely free. All you need to do is just click on services, go to the courses option, and this is where you'll be able to see all our courses listed: the Trading Essentials, Demand Supply trading course, and the Options trading course. So if you want to start with Trading Essentials, click on Get Started, and this is where you'll be able to find the links to the English lessons and the Hindi lessons. So whatever language you're comfortable with, you can click on that and you can start with the learning. So that is the very first step, which is Trading Essentials. After you're done with Trading Essentials, you need to move on to Demand Supply, because if you don't know demand supply methodology, these practical sessions will have no meaning. So that is why it is very, very important you go through our course and learn what is demand supply and get the understanding of it. So again, like I said, once you're on our website, you'll click on demand supply trading course, get started, and again you'll have both the options, English as well as in Hindi. Now, the English lessons and the Hindi lessons are basically the theory part, and like I said, you also need practical application. That is what we do in these sessions, but you will also have access to the previous recordings as well. So this is where you can click YouTube live sessions. You can watch the previous recorded sessions as well. As of now, the archive would be recordings of over 1 year of sessions, so you have a lot of videos available to you which you can go back and watch, and that can help you in understanding how to apply the methodology very mechanically. Now, the next thing is, when we do our analysis, I always say trading has to be very mechanical and rule based, so you need to create a trade plan for you. Now, initially creating a trade plan can be a challenge, so I have created a ready-made trade plan for you, which you can start using from the very first day. And as you gain more and more experience, you can make modifications to it based on your personality style. So how to access these two documents, which will help you in planning trades very mechanically and rule-based. And these two tools are the rulebook and the flowchart. So again, very simple. Once you're on our website, under services, you'll be able to find downloads. And under downloads, you have the rule book and you have the flow chart. So just click on downloads and you'll have these documents with you. So this is the rule book, which is what we will also be using during the session to understand how to plan trades, very mechanically rule based. And we also have the flow chart, which guides us what we need to do as a demand and supply trader step by step. So now that we are done with all the prerequisites, right, where you can access them, let's start with our today's analysis. So like I was talking about, that trading has to be a very mechanical and rule based process, and to help you with that, these two documents will help you. Now, why we should be mechanical and rule based, I have explained this in a video. The title of that video is how to start trading, and in the video description you should be able to find it. In fact, let me see, did I make it easy for you even on our website? Let's see. If I go down, do we have okay, so I don't have that. So probably what I'll do is I'll also add a link, in the maybe the tutorials, right? How to start trading, because that is something which is very, very important. But otherwise, in the video link, you should be able to, in the video, sorry, the session description, you should be able to find it. So make sure you watch that video. That will help you understand why you need to be very mechanical and rule based. And like I said, to help you with that, these documents will help you. Now, our step number one, whenever we start planning our trades, is to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies my expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the very first question is, why do I have to define my trade purpose as my step number one? And the reason for that is, when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frames should I be using for my analysis? Plus, what analysis I need to do on each and every time frame, that in itself is again a challenge. And to help you with this, we do not again start by randomly selecting any time frames. We again go in a very logical way, and that logical way is that the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, if you're trading markets which are not 24-hour markets, like we'll be taking examples from the NSE. So I'm pretty sure you people would have experienced, whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit which is more than what you were expecting on that trade. That's the positive side. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade, and that's the negative side. So we understand that in markets which are not 24-hour markets, keeping the positions overnight has that inherited overnight gap risk, which we would like to avoid initially. And that is why my recommendation to all of you is, your hourly dailies should be strictly done as intraday trades. For weekly monthlies, anyhow, we are not expecting to get the exit the same day, so here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly monthlies you cannot have gap against you. You can still have gap against you. So be careful. But yes, since you're leaning against some bigger time frames, the probability definitely reduces. But with time, with experience, if you want to include daily incomes into overnight, that can also be done. So step one is, I need to define my trade purpose. Let's assume I opted I want to plan monthly income trades. Now, once I have selected my trade purpose, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame, it is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, the intermediate time frame ITF, the lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes, like fine tuning the zone, different kind of entries, like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is, for every purpose of trade, what will be my different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames are monthly, weekly, daily 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our SETS from. And in case I need to use the refining time frame, then my refining time frame will be 60 minutes, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Now, mind it, this table, which is on page number 31, is specifically for the NSE market because it is open for a very short period of time, which is like about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, or even if you're trading some international markets, then you can refer to the table which is on page number 32. So again, based on how long your markets are trading, you can choose between the table which you have on page number 31 and page number 32. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, in this case monthly, weekly, daily, and 60. Plus I also know what analysis I'll be doing on each and every time frame. Now the next, so my challenge number 1 is taken care. I know what time frames I'm using. I know what analysis I'll be doing on each and every time frame. Now the next challenge is that if I take the example of NSE, we have over 2000 plus companies listed on NSE. So it's not humanly possible that I sit and analyze 2000 companies every day. So what I need to do now is we need to have a process in place for selecting some scripts, right? Now this can be done in a number of ways. There are a number of scanner screeners available in the market. You can use any of those. But if you want to scan purely based on demand and supply, then we also have two tools available to you. One is the demand supply zone alerts. The other one is the demand supply zone screener. To have more information about it, you can also click on this link and you can straight away go to the page of these products to understand them better. Otherwise, you can also do this. You can come to our website. Just give me a second. And here also you can see that we just give me a minute. Right, so here also you can see that we have the option which is TradingView indicators. Because these tools are available on TradingView, you can click on alerts to have more information about it. You can click on screener to have more information about it. And that is where you'll understand what these tools are all about, right? So today's session, we are focusing more on analysis. So we'll be skipping this, but very soon I'll be doing some videos where we'll do a walkthrough video of these tools and understand them even better. All right, yes, whatever your let's say your process was, using that process, let's say you got a smaller list. One simple example can be, you might say, okay, I only want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I want to analyze. But one important thing which I forgot to add here is that when I'm talking about these scanner screeners, minded, these are not call giving or tip giving services. These are scanner screeners which will only help you shortlist symbols based on demand supply zones. Once those symbols have been shortlisted, they need to be qualified based on your trade plan, and only if they qualify based on your trade plan, you might look into them as your opportunities. So let's assume whatever methodology you applied, you got a list of symbols. Now the next step will be to analyze them one by one, and out of this, whatever will match with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one was ABC. So what we need to do now is we need to go to the lower time frame and identify zone. Now I understand that initially your eyes are not trained to identify these zones, so that is where we can start with the process which is called as boring exciting candles, and these two indicators are absolutely free indicators. You can use them for free forever, but we are also providing 7 days trial of our demand supply zone indicator, which automatically plots these zones on the chart. So what you can do is you can come to our zone indicator page, and you can click on 7 days free trial, and that is where you can provide your information. and then the trial will be activated for you within 24 hours. Once it gets activated, you'll get notification on TradingView, and then you'll be able to utilize it, right? So you can click on this if you want to go for the 7 days trial if you haven't taken the trial as of now. So yes, now because everyone has access to the 7 days trial, we'll straight away start with the indicator to make our process again more mechanical and easier for us to do the analysis. So let's assume this was the symbol which was shortlisted for me, and can you see, as soon as I go on the symbol and I apply the indicator is automatically identifying where are the demand supply areas on the chart. So can you see, it is telling me that from the current market price, this is where I have my nearest area of demand. Unfortunately, I was definitely looking into it as an opportunity, but the last week when the market crashed, we came pretty close to it, did not get the fill on this. So we can still keep an eye on this. So here we have a drop based rally structure. So let's mark this drop based rally. So can you see my step number 3, which was to identify the zone? The indicator has automatically done it for me. I don't even have to identify where the zones are. So now I am done with my step number 3. Time to move on to the next step, which is the zone available? Answer is yes. Now, once you have identified the zone, does not mean you will blindly trade it. The next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the boosters. So the very first thing we'll check is that, is this zone a case of level on top of level? And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, it is called as a case of level on top of level. So what this tells us is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, we might have a case of level on top of level. But if we don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? Now, in the demand and supply zone indicator, you have the option wherein you can define what is your higher time frame, what is your intermediate time frame, what is your refining time frame, and then you can click on automatic settings so that whenever you come to these time frames, the applicable settings, they get applied automatically. So what I'll do is, you can see I've already set my higher time frame, my intermediate, and my refining time frame. So I'll go to my intermediate, which in this case is weekly, and you will see the indicator will automatically identify zones for me. And here you can see that I also have a weekly zone, which is this drop based rally. So what I'll do is I'll mark this drop based rally, and I'll just change the color so that we can differentiate between the two. So the one in pink is my intermediate time frame demand area, and the one in green is my lower time frame demand area. So you can see this week we definitely came into it, and that is where we started moving up. Unfortunately, we did not get the fill on the lower zone, so maybe it might give you a bounce again, come into the zone, you might be able to participate a little deeper. But as of now, yes, it is still a fresh area. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes. So we do have a coinciding level. So since we have a coinciding level, we can also check, do we have a case of level on top of level? Now, when we talk about level on top of level, it is not mandatory that all the zones might be quality zones. So what I'll do is I'll change the indicator settings that I just don't want to see quality zones. I want to see all demand supply structures. And you will see that as soon as I change this setting, it will again identify areas for me. And now you can see that inside of this, we don't have any demand area. So we only have one zone inside of my intermediate time frame zone, which makes it as a coinciding level, but not a case of level on top of level. So we don't have a case of level on top of level. We only have a coinciding level. So my very first condition, which is level on top of level, is not applicable. Therefore, we are not making any changes to the zone we have already identified. This zone is not because of a gap. Therefore, gap rules will also not apply. Talking about pivot non-authenticity, it is definitely a drop-based rally structure to which we do apply the rules of pivot and non-authentic. So let's see what are the rules for pivot and non-authentic. P-I-V-O-T. So if you talk about pivot or authentic rules, I've given you two approaches. One is the aggressive one, the other one is the conservative one. The aggressive approach says that even before applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what I'm trying to see here is that this move which happened, did it violate an opposing zone? Opposing means if this is demand, opposing will be supply. and that supply has to be of a time frame which is bigger than this, which is the intermediate time frame. So let's verify that. If I go to the weekly time frame, and you can see if I do a replay from here, because this is where the zone was formed, and then you'll see you'll probably be having some supply areas. Can you see you have one supply area, you have a supply area. So when the prices they started moving up, we definitely violated these areas of supply. So going with the aggressive approach, which is where I need a violation of an opposing zone, we definitely have that. So it qualifies based on the aggressive approach. And if I wanted to apply the conservative approach says we are looking for two conditions. One, you need to have an impulsive move on the intermediate time frame, and two, you need to have an authentic zone on the refining time frame. So let's see, do we have an impulsive move on the intermediate? The answer is yes. You can see when we were here, that's my recent pivot high, and the prices were able to violate it and make a new pivot high. So we definitely have an impulsive move. And going with the refining time frame, we need to have a rally based rally structure. Do we have it on the lower on my refining time frame? So let's wait for a few seconds for the indicator to load. So again, the smaller the time frame, the more data it has to analyze. So it will take a little longer. So you need to have patience. So you can see, yes, we do have a zone here, but this zone is more of a drop-based rally, not a rally-based rally. So if I talk about my pivot non-authentic rules, based on the aggressive rule, it is definitely qualified, but based on the conservative rule, it is not qualified. So let's assume I'm a trader who is more inclined towards using the aggressive rule. And again, the reason for that is maybe I want to have more number of trades, right? So let's say I'm a trader who is following aggressive rules. Based on that, this is definitely qualified for me for the pivot non-authentic rule. Next, is it unstable equilibrium? The answer is no. So after applying all the applicable rules, is the zone qualified? The answer is yes, provided you were not applying the conservative rule, right? If you're a trader who is applying conservative rule, then definitely this is not an opportunity for you. But if you're a trader who is going with the aggressive rule, this is definitely qualified as if now. Now, the next thing is we need to understand its quality and the probability factor, for which we'll start applying the boosters. So let's start with the boosters. The very first one is freshness. The zone is definitely fresh. You can see after leaving the zone, price has never been back to the zone. It gets a score of 3. Strength, we do have an explosive move. That is the reason the indicator is identifying it. Otherwise, it would have not identified. Gets a score of 2. Time at the zone, we only have 2 candles in the basing, again gets a score of 2. Reward to risk ratio we are taking as an assumption, therefore we'll give it a score of 3. Now talking about location, you will see that we are also planning this trade at the best location. We have a monthly zone and we are deeply inside of it. So you can see it was a monthly zone, it was a weekly zone. It's just that prices did not go pretty deep for us to get a fill, which is why the zone is still fresh for us. So we'll give it a score of 2 for it, because we are at the best location. At best location, trends become irrelevant. Doesn't matter whether you're in an uptrend, downtrend, or sideways. All 3 of them will get a score of 1. Now, talking about move from the zone, we need at least 4:1 move. And here you can see we have already had a really nice move. Okay, let me draw this. I'll zoom in to draw it a little bit more clearly. So, oops, my bad. That's the tool. From here till here, again, back. So you can see that's my 4:1. We already have a move, which is probably maybe 20:1 or something like that before the prices are returning to the zone. Again, gets a score of 2. It is not a case of level on top of level. We have already verified it, but definitely a coinciding level. And talking about trap, in a way, it becomes irrelevant. And the reason for that is because whether it is a score of 0 or a score of 1, it will still remain as a high probability setup for us. But let's see whether it can work like a trap or not. So for that, we'll take a horizontal line wherever the proximal is. We'll start pushing it up, trying to find an area where the prices have been bouncing over and over again. So if you just look into this area, can you see it has beautifully acted like resistance in the past, then almost acted like support, here again acting like resistance, then acting like support, acting like support. So we have a pretty clean area of support resistance. So people who believe in support would be buying, and their stop losses will be placed below this, which will be sell orders, and those are the stop losses. Plus, if we get a breakout, then people who believe in breakout will also start selling. So we understand by the time we are entering into this area of demand, we'll have a lot of selling coming in, and these people are making 2 novice mistakes. Mistake number 1, selling after a decline in price, which means selling at a cheaper price. And mistake number two, selling in an area where the chart has proven to us that back in history demand exceeded supply. Therefore, that probability is there that this might act like a trap, for which we will give it a score of 1. So let's do that. Let's give it a score of 1. So if you look at the overall scoring, we have a high quality setup and also a high probability setup. And high quality, high probability can be done as a type 1 trade. So this is definitely qualified for us as a type 1 trade. And let's move forward with our next step. So yes, we know this is going to be a type 1 trade for us. The next thing is, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, for which we'll do a proper position size calculation. And next, whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So we'll have to double check before placing our order that does it still qualify based on our trade plan. If the answer is yes, we place our order, in this case a type 1 trade. And once your order has been executed, the last step will be trade management, where step 1 is 1:1. We make it as a break even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. Now, before we move ahead with the Q&As, I would like to add few things first. If you're liking these sessions, do like the video, share it with your friends, family members who are into trading. Or if you're on some trading groups, you can also share there, so that people can take advantage of these sessions. They can take advantage of our 100% free courses. And like I said, before answering the questions which I have in the chat box, I also have an update for you. Now, I'll not be taking all the questions. I'll be taking some random questions, because I have another session which is lined up, which is going to be the Hindi session. And I am also trying to keep these sessions a little shorter now, so that it's easier for everyone to quickly go through these sessions. Now, the one thing which I wanted to add is that we have been getting this feedback from you people that, what if you want to share your analysis, you want me to review your analysis and see whether you're doing the analysis correctly or not, which is not possible through this live session. So now we have an option where you can book a one-to-one appointment with me. You have both the options. If you feel that you can only your questions, they only require, let's say, a voice conversation, then you can book a voice call. If you feel that you would also like to share your screen, or you want to share your charts for me to analyze it, then we can also have an online meeting. So this is where you have the option to book a one-to-one appointment. All right, so let's see what do we have in the chat box now. But like I said, I'll be taking some random queries, because I have a session which is just lined up for me next, which is going to be the same thing in Hindi. All right, so very good afternoon, Sumit. Why does the indicator change the trend when we check mark the show tested zone option? It shows different trend when the option. See, the first thing is, if you go to the indicator settings, you will see that by default, in fact, even if you think about it logically, whenever you are doing the trend analysis, tested zones should be checked marked. Why? Because let's say if I have a demand zone, just as an example, and once it gets tested, if I say I don't want to see tested zones, now the indicator is not including it. But a zone can get tested multiple number of times, and then it might get violated. So that is why you will see that even in the indicator settings, the correct settings are, whenever you are in the intermediate time frame, you have to use all zones for zone violations, and show tested zones should also be check marked, right? So those are the two things you have to take care of. And I think when we do the automatic settings, let me just try it out. I think by default it should take that option. Right, so let me do this. So as of now, I have disabled it. If I say show tested zones, right, so can you see it's showing exactly the same? I'll also try on few other symbols later, but I think when automatic settings are enabled, this at the backend gets enabled by default, right? But otherwise, for your zone violations, we definitely need show tested zones, because once a zone has been tested, just removing it from the chart to avoid violations logically doesn't make sense. All right, so when locating MIT or WIT setup, can we use tested zones or intermediate as well? See, again, this will depend upon different factors. Example, it can be the location. If I'm at the best location, I might be comfortable using a tested zone on the intermediate, but if it is not the best location, I might not do it. Another reason can be your personality style, right? If you're very conservative, you might say, I always want to use fresh areas. Uh, Third example can be somebody who's very aggressive. He might say, okay, even if I have a tested zone, irrespective of where it is located, maybe not very low of the curve, even if it is middle of the curve, I'm okay with it because I want to take more number of trades. I'm an aggressive trader. So it will all depend on your personality style, on your experience, and how you want to go about it. Or can you show your recommended indicator settings for WIT and MIT for analysis? Like what should be the type? See, I keep it as the default settings because in fact, for MITs and DITs, I used to keep it as good, but recently I've also changed this to explosive because I have said this many times during my session that I'm a very conservative trader. But again, keep this at the back of your mind that I also have a very big watch list which I scan every day, right? So currently, I guess the list is around 2,500 plus symbols which I have in my watch list. So again, because I have such a big list, I can be very conservative because I know out of such a big list, I might still be able to find something. But if your watch list is pretty small, then being very conservative might not give you a lot of results, right? So those are the things which you have to keep at the back of your mind. All right. So I plan HIT long trade in 5 minutes. My trend in 15 minutes of favor. Also the location. I am low on the curve. When I check my demand zone, extra confirmation, it shows my demand zone is in supply area. All right. So Vikas, that is why you will see that even in the rule book, I have given this condition as a optional rule. There it is. Okay, where is it? There it is. Can you see optional for HIT? Prefer to have some support from the weekly and the daily time frames, which helps in stacking that extra probability for HIT trades, because most of the times the best looking levels might be at the worst location. And that is what you're talking about, that as a early income trader, you might have been at the best location, but once you see it on the daily, once you see it on the weekly, you might be trading in some daily weekly supply areas, which reduces the probability of that trade setup. Now, should I be taking such a trade? Should I be avoiding such a trade? Again, it boils down to your personality style. Personally, if I see something like this, I would never participate in that trade. But yes, even in that daily supply or weekly supply, we might go a little deeper, which as an early income trader might give you that small little 2:1 or 3:1 you're looking for. But again, this is something I've already added in the rule book. This is some thing which you need to take care of if you want to have that extra probability stacked in your favor. All right. Okay, so Blanco, I'm not sure what you mean by Solana. So if you can give more information about it, maybe. But as of now, I'm blank about what do you mean by that particular word. All right, for level on top of level, if you don't have any other zone than the one we originally planned, then also we'll have to give. No, if you're not having multiple zones and you're not shifting to the lowest one in case of demand and the highest one in case of supply, then it does not qualify as a case of level on top of level. Then it is only a coinciding level. Like in today's example, you saw that we did have a coinciding level, but it was not a case of level on top of level. So LOTL, we gave it a 0, but for coinciding, we definitely gave it a score of 1, right? So if you don't have multiple zones, you don't have a case of level on top of level. So how we book 1:1? See, again, I would not recommend ever to plan trades for 1:1 because we understand that every trade is not going to be a profitable trade, so your rewards have to be bigger. And in fact, if you have not gone through the last session of 2024 where I did the review of all the examples which I shared with you in 2024, go through that session. That will help you understand why it is very important to have a good reward to risk ratio, right? So that is something you need to take care of. That first thing, do not plan trades for 1:1, at least a 2:1. And that review video will help you understand why. Now, if you mean that how do we make it break even at 1:1, that is something I can definitely help you understand. So let's assume that I planned this trade. So because here I don't disclose the values, let's say this was at 100 rupees, I was entering the trade at 99 was my stop loss. So now I know I'm taking a risk of 1 rupee. So when it goes to 1:01, that's 1:1. And at that point of time, you can revise your stop loss, that from 99 I'm putting my stop loss back at 100, so that if the prices they go down, no profit no loss. Yes, you will be incurring a small little brokerage, but if you even want to take care of brokerage, you can add it. Maybe you can give it as, let's say, 100.50, so that if it starts coming back, at least brokerage does not go in, goes from my pocket. So that is how you can make those modifications, but you should never be planning a trade for 1:1. All right, perfect. So that brings us to the end of today's session. Thank you everyone for joining in, and I hope these sessions are helping you. And like I said before, uh, do like the video if these sessions are helping you. And yes, if you're on some trading groups, if you have any family members or friends who are into trading, you can also share the link to my videos, to my courses with them, so that more and more people can take advantage of it. So again, thank you so much. I'll see you next weekend. Till then, trade safe, take care, bye bye.